Hey everybody, in this video we're talking about monetary policy and specifically the story of money expansion. Okay, so what we do during bust times, during a recession, how we try to expand the money supply. Okay, so this is the money expansion story under a limited reserve framework. So we're under a limited reserve framework, so let's get going. We've got two major scenarios, okay, and I want to put those right together because I want students to see the relationship between these two scenarios. Number one is an individual, we're going to call him Joe, is going to walk into a bank and make a deposit. Now, what is important about this scenario, guys, is the banking system is going to get reserves. Joe is going to give reserves to the banking system. So I'm going to put some money in Joe's hand. Okay, those little dashes just represent money. We're going to say $1,000. Joe's going to walk into the bank and deposit that into the bank. And again, the big thing that's happening is banks are getting reserves, okay? And when banks get reserves, the money supply can expand by a multiple of those reserves. What's expanding? Demand deposits. Why are the demand deposits expanding? Because we're getting loans. So again, what's happening is reserves are heading into the banking system. Banks are getting reserves. When that happens, reserves support a multiple of demand deposits. Demand deposits are money. So we're going to see when reserves go in through the form of a deposit, what we can get through loans is those demand deposits expanding and expanding in relation to the reserves that the banking system got. Now, after we master that, we're going to go on to what we really care about, because what you're doing in your classes is you're studying monetary policy. Again, you're studying the money expansion story that can happen in a limited reserve framework, and that's what the Fed wants to happen during bust times, during recessions. So I want to parallel Joe making a deposit with an open market purchase. That's what the Fed does when the economy is in recession, okay? What they're going to do is they're going to purchase bonds, okay, from the banking system. So they're going to purchase bonds. So bonds are going to the Fed, and they're purchasing those bonds to put reserves into the banking system, okay? So in both of these scenarios, what is important is the banking system is getting reserves, and like we've said, guys, when reserves goes into the banking system, they can support a multiple of demand deposits. How are we going to get that multiple of demand deposits? Is through the act of loans. So let's kind of see how these play out, and then we're going to answer these 8 important questions in regards to each scenario. So first, we've got Joe. He walks in, he makes a deposit. Well, bank one is going to say, okay, demand deposits, that's just a checking account of Joe's, okay, which is a liability to the bank. I'm going to even put a subscript Joe, not sure if you can read it, but that says Joe, his demand deposit's going to go up by a positive $1,000, okay? Now at the same time, the bank is getting reserves, okay? These Federal Reserve notes, otherwise known as currency, okay, is becoming bank reserves. We're going to say reserves plus $1,000. So that's going to happen as what we like to call here at Econ Busters transaction 1. And transaction 1 is the scenario. We're just playing out the scenario. Joe makes a deposit. When he makes a deposit, his checking account gets credited $1,000, which is a liability to the bank, and the bank gets reserves. Now, when this happens, okay, we're going to say the required reserve ratio is 10%. So this is going to allow the bank to make a loan. So they're going to make a loan, since the required reserve ratio is 10% of $900, okay? Now, let's just kind of understand that, okay? They have to keep $100 of their reserves, okay, on hand when they get a demand deposit of $1,000, okay? So what is the required reserve ratio? It is the percent of their demand deposit they must keep as reserves. So what's happening is they're allowed to make a loan for $900 because, again, they're going to have to keep $100 as reserves. Now, when they make the loan of $900, we want to immediately say, okay, somebody, whoever got the loan, we're going to call that person Ed, okay? That person's checking account at the bank, their demand deposit, so demand deposits is their checking account, is going to get credited $900. So, it's really easy to understand. So my name Ed walked in the bank, said, hey, I'd like to get a loan for $900. The bank agreed. They signed a loan document, and the moment they signed the loan document, okay, the bank got an asset, a loan. Ed now owes them money, okay? So an asset is anything you own or is owed to you. Ed owes $900 to the bank, but Ed Ed's checking account is going to get credited $900. Ed can walk out of the bank and now go buy goods and services. This right here, that loan, creating that demand deposit, that is the creation of money. That is the money supply beginning to expand from those reserves, okay? As you can see, the reserves have not changed. They're still $1,000. It's the money supply has begun to expand. It was $1,000, now it's $1,900. Now, here's kind of like where it gets a little bit tricky, okay? So they made a loan of $900. They're not going to give cash, so we don't deduct the reserves right off the bat, okay? They still have that $1,000 in their vault, or they're holding at the Fed, either way you want to look at it, okay? They still got the $1,000. They made a loan of $900, but they're thinking, okay, Ed, he's going to go spend this money, right? That's why Ed got a loan, is he wanted to go buy something. So they're thinking, Ed's going to spend this money, and whoever he gives a check to may go back to bank one and deposit it, but very good chance they will go to bank two to deposit. In other words, what I'm saying is Ed's going to go buy something from somebody, okay? We'll call them Sue. And there's a very good chance that Sue, who Ed's going to give his money to buy something from Sue, okay, Sue is going to bank at another bank. So bank one is thinking, okay, I very much might lose some of my reserves when I make a loan to Ed, because he's going to spend it. He's going to give a check to somebody who might bank at another bank, and that's what we're going to have happen. We're going to have Ed walk out of the bank, go buy a pinball machine or something from somebody named Sue. He's going to hand a check to Sue, and Sue is then going to walk into bank two to make a deposit. Sue banks at bank two. She got a check from Ed. She's heading to bank two to make her deposit. So Sue walks into bank two and makes a deposit. Here's how we're going to record it. We're going to say liability, demand deposits. This time, Sue, okay, it's going up by $900 because Ed wrote a check to Sue for $900. At the same time, bank two is going to get reserves. So assets, reserves, plus $900. Now, where did those $900 come from? Well, what's going to happen is this check is going to get cleared. It's going to go through the Fed and then sent back to bank one. Bank one's going to say, oh, a depositor named Ed, he wrote a check to somebody named Sue that banks at bank two. Okay, here's what I need to do. I need to deduct money from Ed's bank account. So liability, demand deposits minus $900, because Ed wrote a check to Sue, so I got to deduct his checking account. Don't worry about Ed, he's got a pinball machine now, right? And then bank one's going to be like, yep, we lost reserves. We lost how many reserves? $900 of reserves. Those $900 of reserves headed over to bank two, okay? Now, what's going to happen next is we're going to get, oh, I'm sorry, I should have said this. T1 was the deposit, didn't say this earlier. This loan is what we call T2, okay? So T1 is Joe makes a deposit. So T1 is transaction one, okay? That's just the language we use here at Econ Buster, okay? You don't have to memorize it or anything, but there's a scenario called Joe makes a deposit. The first transaction of this scenario is the deposit. So you could just see Joe again, 1,000, 1,000. But T2, transaction two, was the loan that the deposit led to. So the deposit led to a loan. Why? Because banks got reserves, right? Then there's going to be a T3, which I'm not even going to write down, okay? It's going to be a loan. And how much is the loan going to be for? 90% of 900, which is 810. And that loan is going to create demand deposits. I can't really help myself. Let's just do it really quickly. There's going to be a loan of 810. And that loan, like we said, creates money. I don't know who got the loan. We'll call him Tim. All right, Tim plus what? 810. And again, bank two, at the moment they make the loan, doesn't lose reserves, but they're thinking, hey, Tim, he might go spend that money, give a check to somebody who banks at a different bank than bank two. So we better watch out, because there's a good chance we're going to lose 810 in reserves if he spends the money or buys something from somebody that banks at a different bank. Okay. We did everything that is really important to do for scenario one, so we are ready for the big 8 questions, okay? The first question was there a change in the monetary base, okay? Well, the thing I like to say to students at this point is this monetary policy right here, somebody making a deposit? No. If it's not monetary policy, if it's not something initiated by the Fed, the monetary base is not changing. It's not changing. Technically, the monetary base is bank reserves plus currency in circulation, and technically currency in circulation went down and and bank reserves went up. Now let me say it again in case I messed that up at all. The monetary base is bank reserves plus currency in circulation. Currency in circulation went down, bank reserves went up. So guess what? The monetary base did not change. The composition did, okay? There's less in circulation, there's more in banks. So currency has moved from circulation into banks as bank reserves, but the monetary base didn't change. But again, conceptually, guys, the bigger thing about this change in the monetary base is the Fed is not doing monetary policy, okay? The Fed is not printing money or destroying money. This is simply a deposit. Therefore, the monetary base did not change. Was there an immediate change in the money supply from the deposit itself? In other words, what your teacher or what the standardized test wants to know at this point is, do deposits change the money supply? No. What happened is currency in circulation went down and demand deposits went up, which are both part of the money supply. Currency in circulation went down, demand deposits went up. Joe, before he went into the bank to buy $1,000 worth of goods and services, he went in, he made his deposit, he walked out with a debit card that had access to $1,000. He can still buy $1,000 of goods and services. The money supply did not change from a deposit. The money supply changes from loans or the repayment of loans. There it is. The money supply changes when there's a loan or a repayment of a loan. Deposits don't change the money supply directly, so no, okay? Those are the first two of the big 8. We can answer both of these by just looking at T1. Just looking right there at T1. There's no loan, money supply didn't change. And also, again, currency in circulation went down, bank reserves went up, the monetary base didn't change. The next questions, okay? The next 6, okay? Maximum initial change in, okay, what's in the blank? Demand deposits, bank lending, or money supply, times the money multiplier. Now, what's the money multiplier? It's 1 over the required reserve ratio. Here's the required reserve ratio. 1 over 10% means the money multiplier is 10. Okay, hopefully that shows up. Try to make that a little darker. The money multiplier is 10. So we get the maximum change in demand deposits, bank lending, or money supply. So in other words, if we put in demand deposits into that blank, demand deposits come out of that blank, okay? If we put bank lending here, bank lending shows up there. If we put money supply there, money supply shows up there. These are the next questions we need to be able to answer for either one of these scenarios. Now, if you're not following me, just stay with me, okay? First of all, don't need that word max right now, just initial change in demand deposits. What was the initial change in demand deposits? Well, Joe made a deposit of $1,000. So we put 1,000 right there. Now, times the money multiplier, which is 10. What is the maximum change in demand deposits we could get in the whole banking system? What is the maximum change in demand deposits we could get in the banking system from this when it all plays out? Bank after bank after bank after bank, 10,000, right? Not hard math to do, just 1,000 times 10 gives us 10,000. What was my maximum initial change in bank lending? Okay, so bank lending. Well, where was my first loan? Oh, it was 900. Now, this loan could have been less than 900. The maximum bank one could loan out was 900. So that's what we're going to put here, 900. Again, it wasn't hard, okay? We started in T1, there wasn't a loan. We're looking for our first loan because this is bank lending, so maximum initial change in bank lending. Okay, no loan. Oh, there's a loan, $900. 900 times 10, 9,000. The maximum change in bank lending that we can get from that $1,000 of reserves going into the banking system is 9,000. Now, final question. What was the maximum initial change in the money supply? Well, when did the money supply change? It changed with that loan. That was the first change in the money supply. The money supply changes when loans are made or loans are repaid. That's when the money supply changes. There's my first loan, first change in the money supply. That's the initial means first. $900, 9,000. We just did it. For scenario 1A, we did the big 8 questions. All right, now I got to get rid of those, okay? Because we need to move on to scenario 2A. Scenario 2A, all right? Scenario 2A is an open market purchase. What's important about an open market purchase? Banks get reserves. Again, what was important about the deposit? Banks get reserves. So what are we trying to understand? That when banks get reserves, that money supply can expand in the form of demand deposits. Why is it expanding? Because of loans. Okay, let's do this. So we've got the Fed Okay, they're going to put reserves in the banking system. How are they going to do that? By purchasing bonds. So here we go. Reserves, you can tell, reserves are going in, so that's going to be a positive. We're going to make it $1,000, so this might be 5 billion, 10 billion, 20 billion. The Fed is going to do this at scale, but we're just going to make it $1,000 just to keep the math simple. So if you can do 1,000, you can do 100 billion. But anyhow, here's 1,000. So reserves are going to go up by 1,000. All right. Now, what are they doing? They're purchasing bonds. What type of bonds? U.S. bonds. You might call them U.S. securities or U.S. Treasury bills or something like that, okay? But they're basically buying debt of the United States government. The Fed is not the United States government. It's the central bank. It's buying the U.S. government's debt, okay? So we just say U.S. bonds. Banks own bonds. They do. They like owning bonds because they earn interest from bonds. So most banks own U.S. government debt. So this is something that's very common. So they go and they buy bonds. So what does that mean? The bank, those bonds are an asset to the bank, okay? They're a liability to the U.S. government. They're an asset to the bank. So the bank is losing these bonds. So we're just going to put U.S. bonds minus 1,000, okay? What people would often say on like CNBC or in the Wall Street Journal or the Financial Times is they say the Fed is doing an asset purchase. That's right. They're buying an asset from banks. What asset are they usually going to buy? Again, U.S. government debt. We're just going to call it U.S. bonds. There's a lot of names. You can say T-bills. There's a lot of things you could say. But anyhow, they're going to buy U.S. government debt, which is an asset to banks. Again, all those like major business channels and business news sources, they would just call this an asset purchase. So the Fed is making an asset purchase, an open market purchase of an asset from the bank to do what? To put reserves into the bank. Now, we got to do, that was T1, by the way. That was T1. We're now ready for transaction 2. Remember, T1 is just the scenario name. It's just the open market purchase. That's all that was with the open market purchase. Transaction 2 from this scenario, the next transaction that's going to happen is a loan. So asset, loan. Now, here's where it gets a little tricky. It's not going to be $900. It's going to be $1,000, okay? Why? Bank 1 did not take on a liability to get their reserves. They sold an asset. What? Well, what's the required reserve ratio? What's the required reserve ratio? What does it mean? It means the required reserve ratio is the percent of demand deposits, of a liability, of demand deposits, a liability a bank must hold in reserves. In this particular situation, the bank didn't take on a liability. They didn't take on a liability to get these reserves. They sold an asset. So how much of these reserves can they lend out, if you want to use that type of language? $1,000. So we're going to say plus 1,000. Again, they don't have to hold on to 10% of anything because they didn't take on a liability. They sold an asset, okay? So the first loan, $1,000. Loans, what do? They create money in the form of demand deposits. By the way, let's give this person a name. Their name is going to be Ann, okay? So Ann went in to get a loan. Ann gets her checking account credited by $1,000. What's Ann then going to do? She's going to walk out of the bank and go buy something from somebody. We're going to call that person John, okay? So she's going to buy something from John. And John, we're going to say banks at Bank 2. So John's going to get a check from Ann, walk into Bank 2 and make a deposit of the check. Liabilities, demand deposits, John, okay? Plus $1,000, all right? And what's going to happen is asset reserves plus $1,000. If you don't understand, pay attention to this. Bank 2 is going to send this check to the Fed. The Fed's going to clear it, send it back to Bank 1. Hey, Bank 1, you got to get your books right. Oh, and one of our depositors wrote a check to somebody who banks at Bank 2. Oh, we got to deduct Ann's checking account $1,000. And oh, we lost reserves. How many reserves did we lose? $1,000. Where did those reserves go? They went over there. Now, what would happen at Bank 2? Well, they can now make another what? Loan. T3. Boy, that red's not coming out, okay? That's about the ugliest I've ever seen. So T3, hopefully that comes out. What's T3 going to be? Another loan. But this loan, okay, this bank got their reserves by taking on a liability. So they can't lend it all out. This loan's only going to be for $900. Demand deposits, who's ever taking out this loan, Bob, okay? Bob takes out the loan. Bob's checking account gets credited. That's supposed to be a D, bad handwriting, $900. And then it's just going to play out. Just like this played out, this is going to play out. We're going to see more and more loans and the money supply continuing to expand. What happened to both of these? The banking system got reserves. When the banking system got reserves, what happened? The money supply can increase by a multiple. Why? What's the money supply increasing? What do we mean by that? Demand deposits are just going to increase. Why? Through the process of loans. Loans create what? Demand deposits. Loans create demand deposits. Loans create what? Demand deposits. Okay, let's finish out the video because it's long enough, right? Big 8 questions again. Was there a change in the monetary policy? Of the monetary base. Was there a change in the monetary base? Was this monetary policy? Yes, this was monetary policy. What did the Fed do? They created these reserves out of thin air. The reserves are part of the monetary base. So absolutely, yes, the monetary base changed, okay? Again, changing the monetary base, we just ask ourselves, was it monetary policy? Was it an open market purchase or an open market sale? If the answer is yes, then either the monetary base increased with an open market purchase or decreased with an open market sale. Was there an immediate change in the money supply? Did the open market purchase, did this T1, did the open market purchase change the money supply? No. The money supply is going to change when we get our loan, our first loan, which doesn't happen until T2. So no right there. Just like this it was a no for this one, no for this one for that immediate change in the money supply. Why? Because it's loans that change the money supply. Next big 6 questions. What was the maximum initial change in demand deposits? Well, let's find the first demand deposit. That's the first demand deposit, $1,000. $1,000. I'm going to answer all of these, and then we'll answer these, okay? What was the maximum initial change in bank lending? So we're looking for the first loan. Where's the first loan? There's the first loan, $1,000. $1,000. What was the max initial change in the money supply? Looking again for a loan. Oh, that's the first, of course. Yes, of course, $1,000. There they are. So what are the answers to these? What is these? This is the max change in demand deposits, $10,000. Max change in bank lending, $10,000. Max change in the money supply, $10,000. Limited reserve framework is what we're talking about. We're talking about the money expansion story when we're in a limited reserve framework. When reserves head into the banking system. Yes, banks can get reserves from a deposit. Sure, okay, fine. The only reason we even study this in our macroeconomics class, the only reason we study this scenario right here is to understand how the money expansion story plays out when banks get reserves. That's the only reason. We study this to understand this scenario. This is the important one. This is monetary policy. This is what you're really focused on in your class trying to understand. And again, an open market purchase, what's happening? Banks are getting reserves, just like this one. And when banks get reserves, again, the money supply can expand by a multiple of those reserves. I hope that makes sense to you. If you stayed through for that whole video, that's a long one. That was awesome. See you in the next video.